All right, Alexis, what is it you want to learn about today?
Well, we were watching It's a Wonderful Life the other day, and we were at that scene where the people were kind of going nuts at the bank trying to get their money. Like, what were they doing and why were they doing it?
All right, so you're talking about the bank run scene. Here, let's see if we can. All right, so it's a wonderful life bank run. So that's what that's called, is a bank run. And then we'll explain it. Yeah.
Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run. Hey, Randy, you got any money in the bank? You better hurry.
Got any money in the bank? You better hurry. So, to understand what's going on here, we're going to do a little bit of an introduction to how a bank works. Okay?
Okay.
All right. So, what do you know about a bank?
Well, that's where people like make accounts to keep their money there if they ever need it.
Okay. So, we're going to draw a bank. This is my little bank. All right.
Very artistic.
Yeah, well, I try. Bank. All right. So, banks generally work on a principle of what's called fractional reserve banking. All right. So, you're right. We go put our money in the bank, right? Lots of people go put their money in the bank. And the reason why they do that is because the bank offers them financial services, right? So the reason that we have our money in the bank is because we want to have a savings account, we want to have a checkings account, we want to be able to put our money into the bank so it can grow, because they pay interest on your savings account, but also like we like to be able to write checks. Some people have either credit cards or debit cards through the bank. Do you know the difference between those two?
Credit card and a debit card?
Yeah.
Doesn't a credit card have like a certain limit and it has a number and stuff that you can go to an ATM and put some money on it?
So the primary difference between a credit card and a debit card is that a credit card will let you spend money that you don't have.
Oh, yeah.
That's why it's
Then
credit.
you get in debt.
Well, yeah, but we use our credit cards. We pay off the balance every month, and so it doesn't become a problem. A debit card is basically like a plastic check. It's just like writing a check, except you swipe your card through it. And so it will only deduct money that's already in your checking account.
Oh.
Okay, but that is a service that the bank offers. So all these people put their money in bank accounts to offer services. Now, the fractional reserve part comes into play is because the bank knows that not everybody's going to take all of their money out every day.
Oh.
Right? So we put a certain amount of money in. If you have a savings account, it's a little bit more difficult to get the money out, so they pay more interest on that. Or they offer a thing called a certificate of deposit, or a CD. You've probably heard Granddad talk about CD. He likes that. And so you have to put your money in for a even longer amount of time, and they will pay you even more interests.
Oh.
And so what happens is they take all this money in, and since not everybody takes it all out at once, so we'll pretend this is the amount of reserves that they get in. And so about here is the amount of money that gets taken out every day to deal with people making their payments, writing their checks, paying their bills, going and buying stuff, or maybe they just want to take it out and move it to somewhere else, right?
All right.
So what the bank does with all of this other money is that is how they make loans, right? Do you know what a loan is?
Sort of. Like they give you that money?
Well, they don't give it to you.
Well,
they loan it to you because you're going to pay it back eventually.
So you borrow the money.
Exactly, except without air quotes. It is literally borrowing, right? So they take this extra money and they make loans. So that is how we got the money to buy our house. That's how we got the money to buy our cars. Is the bank takes that money, they loan it out to people, and then, so yeah, a lot of times it's for big purchases, so cars, because if people have to save up the money, then it's really difficult for them to make big purchases. Like, it takes a long time. But since you have an income, you can get a loan and pay it back. So this is a business. I don't have a good way to draw a business.
Draw like a...
It looks like a Lego. Yeah, there's a sign.
Draw like a Google sign or something, maybe, because that's technically a business.
All right, we'll just business. So, starting a business, buying a home, or building a home, or buying a car. Man, that's an awful car. Those are big purchases, and they take lots of money. And so, what the bank does is they make a loan, right? So, they give you the money. They don't give you the money. You get the money in your account, and then you pay it back over time with interest, right? And so you end up paying the bank back more than you borrowed from them. That's how they make their money, and that's sort of the service charge for the ability to buy this big item. So you pay it back over time. So like with a house, it's like 30 years or 20 years. Cars, it's like 5 years. Businesses are really different, and and a lot of times this kind of stuff rolls over, so that we won't necessarily talk about that. But you're paying it back over time with a percent of interest back each time, and that's how the bank makes its money. So if we think about our bank again, they're making money, they're taking people's deposits, and then they take part of that deposit that comes in, it goes out in a loan, part of it comes back in loan payments and interest, and that's what they use to give back to people interest on like their savings accounts, right? Now, if you remember also, whenever George Bailey goes back to the building and loan, which is another name for a bank, there's not very many of them around anymore because they had sort of a crisis in the 80s, but savings and loan or S&L or like a building trust or names, it's a different kind of bank. So he has a different kind of bank.
Yeah.
Whenever the people are asking for their money, he's telling them, your money's not here, it's in this guy's house and this guy's business and this other guy's house, right? That's what he's talking about. They take in all of this money, and then they use part of it, a fraction of it, to make loans and do business.
So it was in like someone's loan?
That's right. And it's a super important part of a modern economy, because otherwise you spend a big hunk of your life just saving up. So like if you had to save for 30 years before you could buy a house, like you would be old before you could buy a house, right? Like if you start making your income when you're 20 and you have to save up for 30 years to buy a house, right? You're 50 before you can buy a house, right? And people who have families, who want to have yards and want to have lots of room, like that would be bad for them, right? Or if you had to like save up 10 years to buy a car or to start a business, like it sort of gums up the works. But if you can get credit, if you can get a loan, you can sort of jumpstart that process, and it benefits people. It creates, it's part of the foundation of a lot of modern economies. The problem with it is that, so we've got our bank, and these are the deposits, right? This is they only keep this fraction here in, it looks kind of like a sword. That's the fraction that they keep like in the vault, because that's the payments that are going out every day. Now the scene in It's a Wonderful Life, like this time period that it's depicting is the start of the Great Depression.
Oh.
Right. So in this part, this is where he's telling everybody, your money's not here. You know, it's in this other person's account. You know, it's in this person's business. Well, what happens is that, so the Great Depression is this huge economic downturn. Well, that means that the money that's coming back into this portion from loans and interest gets interrupted.
Oh.
right? Because people can't pay their bills, they can't pay off their mortgage, and so all of a sudden the bank runs short of this thing called liquidity, right? Which is basically just means money that you can pay in or out, right? So like cash money that's in your hand
Yeah.
is liquidity. So money that's in your bank that can go in and out is liquidity. Our family owns like stocks and bonds. Those are less liquid because like I would have to sell it first before I could pay a bill. Does that make sense?
Yeah.
All right. Well, so people get scared because the economy is going down and they know that their money is at the bank and that it's not necessarily, they feel safer if they have it in their hand, or they may know that the bank doesn't have enough money on hand to just, if every single account holder went and said, I want to take my money out right now, they may know that the bank doesn't just keep that much money laying around, right? And so they go and they try and get their money out of the bank, and all of a sudden, this is how much money that you have to pay out, and this is how much money people start asking for.
Oh, dang.
And so you don't have enough money. And then it becomes a self-perpetuating cycle because so we're sitting here, if it pops up on Facebook, of course they didn't have Facebook back then, but however the news traveled, like if you're George Bailey and you're rolling down the street and you see that the bank where you're banking at is all of a sudden everybody's running in and they're coming out with all of their money, you get scared too. You think that they know something you don't, or you just know that whoever's the last one in may lose their money, right? Because as all of this money starts going out, the bank can't pay its bills. It can't operate because it has bills too, right? So it may go out of business. And so if you don't go and get your money out, then you get left with nothing.
Oh, man.
Right? And so all these people, and it's a bank run.
That would suck.
And it's a crisis of economics. It's a crisis of confidence. And so all of that stuff happens at once, and that's what's happening is all those people are rushing in to go get their money out all at the same time, and it becomes a self-perpetuating sort of death spiral because the more people run on the bank, the more unstable the bank comes, the more people get scared and want to get their money out, so then the run just keeps getting deeper and deeper.
That's a vicious cycle.
Yes. So the good news is that since that time, we've done things to try and prevent that from happening. So one of the problems in the Great Depression was there was a law that required that banks did this thing called unit banking, right? And it made it illegal to have a branch, is what that means, right? Now, so our bank that's in our town is not actually like, of course they have all the people and they have leadership that's here, but it is a branch of a larger bank, right? So the main bank is actually in another town, and then there are smaller branches that are sort of spread out. And now in the United States, like there's banks that operate all over the entire country. Some of them operate over the entire world. So Becky, right? She works for U.S. Bank, I think. So it banks all across the entire country.
Whoa.
Right? But in this time period, it was against the law to have a bank that was spread out like that. And like most sort of laws that get written, they have a good intention, but they have a bad effect. Because people thought, well, if we force your bank to only sort of service your little town, then the people who are making decisions about your loans and your accounts, they're local and they're going to care about you more, right? And the problem with it is that these banks were very fragile. All right, so if you think about it, the economy in every state all over the country and, different places all over the world is different. So that's an awful little state there. Let's try this again. All right, so in oil and gas is very important, right? So you know that, right?
Yeah.
Yeah, and that's why whenever people talk about, the price of gas going down and, oil and gas being disrupted, that's why we're always sad about it, because those are the families that we go to school with, families we work with, families we go to church with. Their moms and dads and husbands and wives and aunts and uncles are all employed either in the oil field or supporting the oil field. And so whenever those businesses get hurt, right, it hurts the families we know. Well, if you had a bank that just serviced this little part of Oklahoma and the oil and gas industry went down, it would be bad for that bank. That bank would be unstable because most of the businesses that it worked with would suddenly not have as much money on hand. The families that it had made mortgages and loans to, they wouldn't be able to pay their bills, and so that bank would be unstable, and so it would be fragile, right? And they talk about that a little bit in It's a Wonderful Life if you kind of pay attention, because they had like a mill or something that was there that shut down, and George was talking to his friend to try and get some kind of industry back in there and start it back up as something else.
Something like that.
Yeah, that's part of the problem with Bedford Falls, is that their largest employer has sort of gone out of business. And during the time of the Great Depression, you had that situation in pretty much every town all across the country, is because you had these small localized banks. Whenever the local economy started going down, then the banks become unstable and they would start getting runs on them, right? Well, they've changed the law since then, and now we have branch banking, and so that helps. One of the other things that they did is they passed a law and they created this thing called the FDIC, right? The Federal Deposit Insurance Company. And what that basically says is up to a limit, like it's not limitless. I think it might be $250,000 now. It used to be smaller. But if you have a deposit in a bank, then that bank is insured by the federal government. So if the bank fails, then the FDIC will make you whole. They will pay the customer whatever it was that they had deposited in the bank. And so that makes the bank a little bit more secure. It makes people more confident, so that they're less likely to run, because even if the bank fails, that at least you're going to get your money.
So if the bank doesn't give you the money, then this will?
Yes, the FDIC. Now, people will debate if the FDIC is all good or all bad, because it also introduces this thing called moral hazard. Oh man, that's an O and that's an A. Moral hazard. And moral hazard is when the results of your decisions are sort of separated from the consequences. This is the business term for that situation. And what happens is, because the FDIC is insuring people's deposits, then some people believe that creates a situation where bankers may be more inclined to take that money and invest it in riskier assets. Because if I'm a banker and I don't have any morals, and like I'm a lawyer, I take this money from all my depositors and I think to myself, well, nobody's going to get hurt if the bank fails, because the FDIC is going to make all the people whole. And so I stand to benefit a great deal if I take this money and I invest it in something riskier, because that means I'll make a lot of money, because then I'll get bonuses, like the bank will be making a lot more money. If I have stock in the bank as part of my compensation package, which is a thing, like if you're a high-powered leader in a business, like a CEO or another officer, a lot of times they don't just pay you in money, they pay you in little ownership pieces of the company. They pay you in stocks. And so that means that if you can make the company much more profitable, you stand to increase your wealth a lot more because that company gets more profitable. The shares that you own increase in value, and so you're getting richer by making the company work better. So it's a good thing, but it also creates a situation where, if you can get that stock to go up by doing something that's much more risky, you're benefiting yourself, but you're putting the depositor's money at risk, but you may feel like it doesn't matter because the FDIC is what's going to make them whole. Does that make sense?
Yeah, so they're not going to pay you the money, so you'll get it from the FDIC, but you're going to take it and invest in something risky that might end up losing money.
That's right. So, and again, this is something that kind of pops up in A Wonderful Life, like whenever the crazy Uncle Billy, whenever he loses the money,
oh my gosh,
and he has to go to Potter to ask for money.
Oh yeah.
He says to him, he's like, "Have you been speculating? Have you been playing the market with the people's money? Have you been doing all this stuff?" And George is like, "No, no, no, no." So what he's talking about is that so usually the bank invests in loans, and loans are considered to be safe because you go and here, we'll do it this way, we'll make the risk go up, so
because it's a high risk situation.
yeah, so the risk gets higher as we go. So loans are considered to be safe because you check the people out. Like whenever we go get whenever we go get a loan for the house, they look at all of our taxes, and because the taxes are by law, we'll throw you in jail if you screw them up, record of our income. And so they can see, oh, you've been making this much money. And the people that run the bank, it's their job to look at the assets that you have, okay, so we've got land, we've got a house, we've got a car, we make this much money, so they look at that and they determine if you're risky or not. And then so they'll make you a loan. So loans are considered to be safe because that money should be coming back, and you should have only given a loan to somebody that you know that you can pay back. Make sense?
Yeah.
All right. So a little more risky, but still fairly safe. Actually, it may be less risky. But the other thing they deal in a lot are what are called Treasuries or T-bills. And that's basically a loan from the government. And they're considered to be super safe because the government is guaranteed to pay them back, and the government, even if it can't pay its bills, can always print money. So if the U.S. government owes you $5, it can always just print out $5.
Why would the U.S. government have bills? Don't they kind of make the bills?
Well, I'm just saying, the finances of the government, this will be a whole nother video if we talk about sovereign debt and financing the government. But the general idea is they're considered safe because if the U.S. government needs money to pay back a treasury, so it's a bond, you borrow money, right? The government's borrowing money from different people to help run the different functions of government. You're borrowing money over what your taxes are, and then the government pays it back to you. It's considered to be super safe because if the government can't run out of money, it can always print more, is sort of like the theory. And like I said, it'll be a whole thing. But a lot of times banks will invest in those because they are still very safe, and because they're safe and they have a determined value, they will actually trade them back and forth almost like their money. So another thing they can invest in is they can do other kinds of bonds, which is so a business or another country may want to raise money, and so they'll sell bonds, which is, a bond is kind of like a loan. It's just structured differently, right? And so, but they'll buy those bonds, and because they're usually more risky, they pay a higher percentage.
Oh.
Okay. And then you start getting into stuff you may do stocks, which is an investment, it's a ownership of a piece of a company. And they can make you money because the company pays what's called a dividend, which is whenever they take some of their profits and they give it back to the owners, or its value just goes up, right? When I was in school, a buddy of mine named Aaron, he was fascinated with the stock market. He wanted to he didn't have enough money to actually get into it, but he wanted to invest in Dell computers. And like later on, if you looked at it, like the value of Dell computers went up like that, right? So that's a lot of money, and you make those by the value goes up, and then so you sell it to someone else. Or you can do speculative stuff, which is where you're trying to buy and sell things and not necessarily own it. Which is
buy and sell stuff, but you don't own the stuff?
right. So going and buying a stock is an investment, right? I own that little piece, and so it may go down in value, it may go up, but even if the company craps out completely, I still own a little piece of that company, and so I may get a little bit of value back when they sell off the equipment and the buildings and stuff like that, right?
Yeah.
So speculation is where you buy, like maybe you do like a short, which is a short sale, which is where you are predicting that something's going to go down. So if I have a company and I think it's going to go down, I think it's going to lose value, they're going to mess something up, I can short it. And it's complicated, that's probably a whole nother video, but in essence what you're doing is you're borrowing shares of that company from somebody else, and then you sell them at this higher price up here, and then you're hoping to buy them back at this lower price so that you can give them back to the person that you borrowed them from, and that you have this difference in price is your profit. Does that make sense?
Yeah.
Okay. The problem with that is, so you borrow the shares from somebody, you sell them at this price, right? If the company went up, you have to buy them back at the higher price to give them back to the person you borrowed them from, and you lost money.
That's
right?
kind of a 50-50 situation.
Well, it depends. Like people that do it, they have to do a lot of research, but that situation is speculation, and it is very high risk, but you can stand to make a lot of money on a short period of time if you can predict it correctly. But you stand to lose a lot because, like I said with a stock, even if your stocks go bad and they lose value, you may lose money, but you still may get something back because you own a little piece of the company, or you can just hold on to the company and hope that they eventually turn it around and ride it out. Does that make sense? Like they may eventually get their act together. There are people who believe that the FDIC, because they're eventually going to pay back your depositors, makes this kind of situation, it makes it more likely that a bank is going to engage in risk, right? Because you're not going to be like George Bailey, where he's giving out his honeymoon money to make his depositors whole and try and keep them in the bank, right?
Yeah.
If you're not going to be that guy, then it may encourage more risk. And the FDIC has changed a little bit. Used to, basically everybody paid pretty much the same amount of money, and so that did make it a lot riskier, but they have adjusted to where if they look at what the bank's doing, and if you're doing riskier stuff, they charge you a higher price for your insurance, because the banks have to pay into it, right? It's not totally free. It's backed by the government, but all of these different little banks they're basically paying for it like it's like we pay for our health insurance or anything else, right? And then so the FDIC there has been some changes made where they will evaluate your risk and they will charge you more if you're doing riskier things. Does that make sense?
Yeah.
You have any questions so far?
No, not right
Okay.
now.
So one of the other things that has happened is, so the Fed has, it looks like a lowercase b. The Fed which is the Federal Reserve Bank. It's the central bank of the United States. They have a lot more tools to try and make the banking system more stable, to try and prevent that kind of stuff. So one of the things they do is they have control of a certain number of interest rates, and they will move those up and down And they don't, it's not necessarily where they're dictating to the bank, hey, you have to charge this much interest for people, but they control some other markets that have interest rates that the banks sort of play in. And they will raise the interest rates, which means the banks are less likely to lend out. And it makes them less likely to lend out to riskier businesses specifically. And so if the economy's running, if we'll call it running hot, the economy's doing real well, and they think that there might be risk growing in the system, or what they'll call it bubbles, like assets are getting really expensive because that money's trying to find different places to work. They'll raise the interest rates, and it will lower the amount of lending, and it should also lower the amount of risk, right? The other thing that it does, though, is it kind of slows down the economy. So eventually they may have to lower the interest rate to sort of get the economy back up again, because as that lending goes down, the amount of economic activity goes down.
So they'll lower, like, make it go up the rates to sort of balance things out.
Yeah, they try and keep inflation and economic activity and risk all sort of in a nice balanced pace. Ideally, your growth would just be sort of this nice even straight line up. It doesn't always work out. It never works out that way. But they will raise those rates up and down, and part of the reason that they do that is they're trying to create stability in the banks, because at different points in different financial crises, that's one of the things that happens. If interest rates are really low, people want to get loans because the money's, it's cheap money, because you're having to pay back less to get your loans. And so there's a lot of activity, there's a lot of buying, so it strengthens the economy. It makes the stock market goes up, because since the interest rates are low on things like loans, people that want to take their money and invest it in things like the stock market, because the stock market is going to create a higher return because it's more risky, right? And so all of that stuff builds up, and then if you have a lot of economic activity, or if you have rising inflation and you have low unemployment, things like that, the Fed will lower those interest rates and try to reduce the amount of loans, right? I sort of lost track of what I was trying to explain. So what happens is when people want lots of loans, though, there's an incentive for these banks to make loans to people who can't necessarily pay them back.
Oh.
And then eventually the economy doesn't do this, it does one of these, and when it does, you have a bunch of people that can't pay their bills, and then all of a sudden the banks are in trouble because they have all of these loans that people can't pay back. And if they're mortgages, which are for houses, if the housing market crashes, technically the bank can do what's called a foreclosure, which is, since you can't pay your loan, we're going to take the house that you bought with that loan, which is bad for people. But if the housing market has gone down, it doesn't really help out the bank, because it's not like they can sell it and recoup their loss. Does that make sense?
Yeah, so they'll repossess your stuff that you use the loan to buy.
Yeah. So if we went out, so we've got a mortgage on this house. If we couldn't pay it back, the bank could foreclose and take the house. This is the collateral, right? And if the housing market is stable, then the bank will resell it, and they'll try and take that to make up their loss, right? So that they don't end up losing money on our loan.
Oh.
Right? Well, if the housing market has gone down, though, then it doesn't really do them any good to foreclose, because they can't sell the house. Or if they sell it, they can't sell it for the value, and so they start taking losses, right? And it becomes a financial crisis. It creates instability in the banks. And this is one of the tools the Fed tries to use to fix that, is that whenever there's a lot of that economic activity, a lot of that loan activity, they'll raise the interest rates to try and discourage the banks from making risky loans.
That makes sense.
Okay. One of the other things they have is they have this deal called the discount window, right? And the discount window is where if a bank is in trouble, one of the things they can do, so if the bank's in trouble, they can do sort of three things to try and get money. So people are coming, they think the bank's unstable, they want to take their money out, right? And the bank doesn't have enough money to give out. Well, the banks usually have assets. They have loans, they have bonds, they have stocks, they have things like that. Well, they can sell them, just sell them for whatever they're worth, and then take that money to pay their bills and to pay their depositors that are trying to take their money out, right? If this has resulted from an economic crisis of some kind, then that may not be a good option for you because the value of those assets will have gone down, right? So if I own a bunch of stocks and I'm a bank and my customers are wanting to take money out, and well, I can sell those stocks to raise the cash to pay to them, but if there's an economic crisis, that probably means the stock market has gone down, and so the value of that stocks have gone down. And so if I sell them off, I'm not getting in as much money. I'm having to take losses to give them to pay my depositors. Does that make sense?
Yeah.
So one of the other things they can do is they can get a loan, right? And they can go to like another bank and they can say, hey, I have these stocks, I have a treasury, I have these loans. Like, will you give me a loan? And they'll use that as collateral to get money so that they can sort of ride out the run. And hopefully, eventually, when the economy picks back up, they'll be able to pay back that loan and they'll get their assets back. Does that make sense?
Yeah.
Right. So the discount window is sort of cheap money that the Fed runs. And it's only it's supposed to be only in case of emergency. And they've tried to reform it because it's sort of a public thing where so if your bank goes and uses the discount window, people know about it. And that tends to make people think that your bank might be unstable, and so it might create instability while it's trying to prevent it. They're doing some reforms to try and fix that, but it's basically the same thing. If you have assets, you can go to the Fed discount window and you can say, hey, I've got these loans, I've got stocks, bonds, whatever. I'm going to put them up as collateral, and you can get a low interest loan back from the Federal Reserve to try and meet your liquidity needs and hopefully ride out whatever rough patch there is until you can pay that back and you can get your asset back. And so there's a little less risk getting a loan like that you'll have to take a loss, right, as opposed to selling it. Does that make sense?
Yeah.
Yeah. Are you sure?
Yeah.
Okay. Do you have?
I kind of get it, because if there is a crisis, then it would make more sense to get the loan, because if you sell the stuff, it won't be you won't get as much money.
Right. Well, and it's the price of your assets is down forever. It's locked in because you sold it. Like if I had something that was worth $100 and then there was a crisis, well, I sold it off as $50 to try and just pay off my creditors. That $50 loss is permanent. Whereas I can use it and I can go and say, hey, I've got this $100 asset. Can I get $75 or $80 for it so that you can hopefully ride out the crisis? And then if you're able to sort of get your cash flow back, ride out the crisis, then you don't have to give up that asset, and it's just you have a chance of keeping your bank more whole on the end. Make sense?
Yeah.
Have any more questions?
Nope.
All right, so that is what a bank run is. That is what was happening in that scene. That's why it happens. It happens from fractional reserve banking. It's because people get scared, and we have done some things to try and fix that with the FDIC and the Federal Reserve, and by allowing banks to have branches. Make sense?
Yep.
Awesome, thanks.